Hi, folks. This is Dave Workman of Workman Associates with another episode of individuals that I count on to help me provide the financial information for you. Today, I have Ryan Detrick, the Chief Marketing Strategist for LPL Financial. And Ryan, welcome. Ryan, we welcome today. Where are you at right now, Ryan? Where are you located?
Well, I see some snow behind you there, Dave. I'm actually, LPL Financial has a big office in Fort Mill, South Carolina. That's just south of Charlotte. I live in a town called Tega, which is right next door. I am at home today. I do go to the office sometimes, but that's where I am. And I'm looking outside and it's cold, but we don't have any snow.
Well, I tell you, that's just one of the benefits of living in Indiana. I mean, we've got all sorts of benefits here, Ryan. And if it's Indiana, it's going to snow a little bit, and especially during sectional basketball week. It's always like whenever sectionals start, it's got to be a snowstorm. So girls sectionals started, so it's just a rites of passage. Hey, Ryan, first of all, folks, let me explain something to you. Ryan is a very busy guy. He's on national television. He takes care of 17,000 brokers in regards to the marketing strategies. And so I really welcome him here and appreciate it. Ryan, why don't you in the 30, 60 seconds kind of give the listeners an idea about what you do, if that's enough time. If not, take as much as you want.
Well, I hopefully can do that. By the way, I'm from Springfield, Ohio originally. So at home, I'm a Midwestern boy. I did move down 5 years ago
There
with
you go.
LPL. And now I'm, like we said, the chief market strategist. My role is a lot of fun, right? I get to talk about markets, get to present. I used to travel. We used to travel, talk to a room. I joke I'm good at speaking while other people eat anymore. Now they just watch me in a room by myself. But, I also work with a really smart team. We manage over $50 billion. Have about a 30-person research team. So I work with portfolio managers, analysts, strategists, and it's a lot of fun. I say a strategist draws the snowman. The big picture. Do we like stocks over bonds? Do we like large over small? How we see fixed income, and kind of my voice, and then it trickles down, if you will, to the portfolio managers and strategists, and try to create the models that we run for our advisors and for their clients. And it's something we don't take lightly. It's a lot of fun. But at the end of the day, I'm a mouthpiece for a 30-person research team that manages a lot of money, and every day is different, but I really love it.
Well, that's fantastic. Well, I want to jump in. I'm going to kind of cover some wide variety of topics that have been brought to my attention. But I guess the first one really is that can you give a very basic explanation of what happened with this GameStop trading and the silver trading? And then I'm going to pour over into that whether or not the average investor should be alarmed by it, and whether you thought it hurt the integrity of the trading platforms on which that happened.
Perfect. So we'll start off with, kind of what happened, right? I mean, GameStop it took America by storm last week, if you will. For the month of January, the stock was up like 1,600%, up 400% last week. To keep it simple, most people buy a stock, right? Well, you can actually sell a stock short. And all that means is you're selling it first, going to buy it second. So you're trying to pocket a difference. GameStop was the most shorted stock out of all of them. All right. There's like 3,000 stocks on the Russell 3000. That was the most shortest stock. In other words, all the big hedge funds and everybody was betting against it. You think about it, they sell video games, okay, which people do online now, and they're in malls. No one really goes to malls in a pandemic. So they're in a really tough area. Their stock has done very poorly. But the Reddit community and a lot of these online traders knew that was the most shorted stocks. They said, hey, let's all buy it at the same time and see if we can push this thing higher. And then we call it a short covering rally. All that means is it's going higher. So those shorts are wrong. They got to buy it back. And then you can have a rocket ship higher. And we've seen short covering rallies before. I think I'll kind of talk about that in the next question or two. But that's what happened. And it's not just GameStop. There were a lot of other stocks that were beaten up that did something similar. And then you kind of opened the door to silver, which was up 20%. I know silver was down yesterday, up a little today as we're recording this, but silver is up 20% 3 days last week and earlier this week. So silver is kind of one of those shorted ones that the crowd is kind of moving to. So it's a really unique dynamic. But I'll just leave it with this, and you ask me this question. It's not the first time we've seen a short covering rally, and it's probably not the last time we've seen a short covering rally.
It's just with technology, it speeds things up. I mean, and we've seen that. I mean, we've seen that with this pandemic in regards to so many parts of the economy. And I'm going to visit with you about that. So my next question would be, we've seen it before, which we have. Do you think that the average investor, now I know news sources have really covered this, And my question is, should the average investor, someone who's retired, got their money in the mutual funds, taking systematic withdrawals, should they be overly concerned that a small group can take over an equity and cause it to have a ripple effect? Because if they're covering shorts, they have to sell something else, and then that's going to cause those stocks to go down. How would you answer that?
Yeah, yeah, we would say no. All right. I mean, a longer term investor, some of these speculative small names. GameStop was $5 a share last summer, then it goes to $500 a share. So that's kind of the extreme. And the worry last week was, is this the first domino to fall? Because on the other side of those trades, you have places like Melvin Capital, which is a $10-12 billion fund. And the worry was, some of these institutions on the wrong side of this trade, what if they go under? What if it's a 1998? Real quickly, something called long-term capital management, the most successful, largest hedge fund in the world, made some bets on the Russian ruble that were not supposed to happen. Russian ruble moved more than any of their models expected, and that cascaded into a 20% correction. Fed had to step in, global markets had to step in. As of this second, as of right now, we're not comparing what happened to GameStop with the Russian ruble. Now, I will say this though: on Wednesday, the move GameStop made, Dave, was a 5 standard deviation. For everyone listening, a 5 standard deviation is supposed to happen once every 13,900 years. It happened just last week. It's funny how the stock market seems to have these big moves more than it priced in. But at the same time, earnings have been amazing. Okay. Earnings have been super strong. Just this morning, we had really strong services numbers. We got strong manufacturing numbers. The truth is, GameStop's the shiny object that everyone sees and it's moving. So it's a fascinating story. Don't get me wrong. I've been reading up on it. It's really fascinating. But for your average long-term investor, you shouldn't be overly concerned about these small moves doing this, because the economy is really healthy and honestly improving.
Well, that's great. And for folks, just to give you a timeline, we are recording this on Wednesday, February 3rd. And so it'll probably be 2 or 3 days before we get it out, but just to give folks some relevance.
Got it.
Well, that's great. If you had to list some areas of the economy affected by the pandemic, long term, not short term, but long term, are there 1 or 2 or 3 areas you'd pick that were affected positively, and 1 or 2 or 3 areas that you've affected negatively? And I'm not talking about just in this really small time frame that we're talking about, which this last 12 months, it seems like the old saying, I spent a week there one night. I spent a decade last year, kind of thing. But I mean, longer term, that you see that we're not going to go back to the normal pre-COVID. I'm going to call. I don't even call it the new normal. I'm calling it the post-COVID. Do you see the economy post-COVID? But there's been some areas affected that will be changed permanently. Some for the better, some for the worse.
Yeah, we do. I mean, honestly, look what you and I are doing right now, right? We're doing a Zoom call. I mean, this is the way we are going to start communicating. But we start, some of the positives. I mean, what's happened in healthcare, right? The battle COVID and all the money that's going there, it's truly amazing. And something like biotech stocks really can have potential continued growth. And it's amazing what's happened there, but just technology in general. All right, people said, oh, I'm going to work from home now. Let's start buying technology and build it in my house, and that's a major theme that we don't see changing. I mean, at LPL, we've got like 3,000 employees in the office about 5 miles from where I'm sitting right now. I think like 100 a day go in, and we're saying, yeah, we'll open up eventually. But, this whole working from home, working remotely is here to stay. And again, that very well can continue to benefit technology, and healthcare has got a tailwind too. Who's it going to hurt? I mean, you think about the financial crisis. For 10 years after financial crisis, who didn't do well? It was bank stocks. After the tech bubble for about 10 years, who didn't do well? It was tech stocks right after that bubble. And so it's like the scene of the crime is the group that it struggles the most. The scene of the crime now, it's your airlines, it's your cruise ships, it's your hotels. It's some of the real estate. Not to say there's not opportunities there, but from a bigger picture, the scene of the crime is the area that kind of struggles going forward, and that's the groups that we still think, might be in trouble. I mean, Amazon. My goodness, look at their earnings, right? Incredible earnings. Jeff Bezos made so much money. He says, "I'm going to step down, maybe enjoy life a little bit." Hey, can't blame the guy, But it's like those are some of those groups that have really done so well, and they're gobbling up so much of the market share. And it's an interesting conversation for what does that really mean for everybody. But that's what's happened. The strong have gotten stronger during this, and That's just kind of the truth. Now, the other side of things, markets, the other thing is, the Fed, my goodness gracious, the Fed is, we've learned, don't fight the Fed. The Fed is extremely powerful. Now we've got Janet Yellen in charge of the Treasury. Now she was the former Fed chairperson. Now we've got Janet Yellen up there and the Fed is so powerful working together. So it's like, wow, there's a lot of power here. And I don't know if it's good, I don't know if it's bad, but I do think it's probably positive for stock markets because they want to continue to keep ththings going. So that's another angle on what happened the past, we'll call it 11 months, I guess, and we didn't see coming at all.
Yeah. Well, that's a very good point. I not that it matters, but I concur with you because, we might drive by a hotel and the parking lot is almost empty. Obviously, airline, we haven't flown any, but the people we talk about, I just read an article about a traveler went from the United States to Germany, and they moved everybody up to first class because there were 21 people on there. So,
wow.
So I think that's exactly right. So your general assessment, if you give me a lot of people confuse the economy with its equity markets, and I know that they aren't, but can you give me a 30-second view of the economy in your opinion, and maybe a little bit of a 30-second view of U.S. equities, non-U.S. equities, and bonds? And as I said, take as much time as you want, but
yeah, we'll start with the economy first. I mean, the economy's opening up, right? We've got the vaccines. We know that. We continue to get positive news there. More people have been vaccinated with the first dose of a vaccine than have had the COVID-19 in the United States. So we're opening up the economy. All right. And again, what really gets us with the economy, manufacturing is extremely strong. If you look at how quickly it's bouncing back, we've seen some record numbers, Dave, in manufacturing. Manufacturing, it turns out, is about a 6-month lead to earnings. Okay, so if manufacturing is strong, wait about 6 months, earnings are going to be strong. Earnings have really come back, but that's a big time positive, kind of canary in the coal mine in a good way, that earnings are going to come back to help drive this economic expansion. And don't forget this, the average economic expansion lasts about 5 years. All right, this one just started probably late last summer or late last fall. So this is a young economic expansion. Be open to the idea that we can go several years with the economy continuing to chug along. Looking at equities, earnings are going to drive things. We still like the U.S. a lot. Probably you could say maybe our favorite pocket is actually emerging markets, though. A lot of growth, some good valuations, and some of the models that we run for our advisors, we've got a little bit of an overweight to emerging markets. So we like the U.S., like emerging markets. We don't like developed internationals much, specifically Europe. Still some structural problems in Europe there. But overall, that's kind of how we see the world. I guess to put a bow on it, though, we think this is a major secular bull market that might potentially last years. I know that sounds crazy, but after what we just went through, but you see these big pullbacks, they don't just stop after a year. All right, you tend to have higher prices for a while with an economy strong, with a Fed that's still there, and with fiscal policy. We haven't even talked about that, the fiscal policy to help things. There's a lot of tailwinds for investors that there could still be some pretty good times on your 401k statements for quite a while to go, hopefully years to go, to be honest.
That's excellent. Number one question I get from my investors are, how can we sustain this national debt? And will we have anybody that be able to do anything about it, because no politician ever got elected by promising less. And so is there any way, anything that you would bring to the table on that?
Well, that's probably the number one question, other than GameStop. That's probably the number one question we've received at LPL Research over the last month or two also. And the truth is, we have record numbers of debt from the United States government. But, as we like to say, peel back the onion. Corporations are in really good shape. Dave, the average FICO score for you and I, the U.S. consumers, actually went up during this recession. Okay, credit card debt went down more, but how much you pay on your mortgage has gone down because interest rates have gone down. So it's kind of two stories. Yes, there's a ton of debt for the United States, but under the surface, the corporations and consumers are honestly pretty healthy. Now, some people are still struggling with the recession and what we're still dealing with. We understand that, but on the whole, the economy is truly looking pretty good. The other thing about debt to remember, the truth of the matter is this: we have the world's reserve currency. Back in March, a year ago, when stocks got killed, bonds got killed, and even gold got killed, if you remember those scary, scary days, the US dollar was the only thing that went up. That was a reminder to not just Republicans or Democrats, everybody, that we've got the world's reserve currency. And I'm not saying it's right. I'm not saying it's wrong, but when you have the world's reserve currency with historically low rates, you can leverage more debt because people are going to come to it, right? They trust you, right? We've got the world's reserve currency, so we can take advantage of it. And again, it's something that we don't see slowing down, is the honest to God truth also. I mean, more debt's coming, like you said. The positive to it, if there's any positive, is rates are so low. How much the United States paid on all of our debt last year, 2020, when we added a ton, was actually less than what we paid on our debt in 2015 and 2016. How's that possible? It's because rates are lower. Now, the flip side of that is what if the 10-year yield goes up to 5%? And then I'd say, well, Dave, let's talk about that a different day. That'd be a worrisome sign. But it's a bunch of ways to slice and dice it. But the truth is corporations and people are in really good shape. The debt in the country's high, but we've had high debt for a long time, honestly, in our country. That's the other side of this.
Well, I tell people we buy companies, not countries.
Exactly. Good point.
And that's an amazing statistic about the debt. The actual debt service based upon the interest rates, that we're actually paying a smaller portion of the income is less than what it had been in 2015. That's outstanding. Well, I tell you, one last question, Ryan. I have clients in about 30 states and about 1,800 households. And so you've answered a lot of stuff, but to those investors, it sounds like you're saying the economy is improving because of COVID, that the balance sheets of companies and households are pretty strong, that earnings, which is, I try to explain to folks, earnings is basically the blood pressure of the economy. I mean, if there's one thing you want to look at, that's what should be looked at is earnings. It sounds as if you're fairly positive. There's always going to be bumps. There's always going to be unknowns. Doing this 35 years myself, that's always going to happen. I mean, it's funny when you mentioned the Russian ruble crisis, because I remember that. I remember that was a big deal. Oh, yeah. And so it sounds like you're saying, hey, it's not perfect. There's always going to be trials and tribulations. But if you look at it from a financial, economic, non-emotional perspective, which is hard to do, it's looking fairly good.
No, that's exactly right. Now, I don't want to just be Pollyanna here. I mean, There are always worries and concerns. And one thing, I think you laid it out very well there. We think, the economic cycle of growth and likely stock gains are coming, next 1, 2, 3 years. But let's be honest, we just had a 72% rally, honestly, after this morning, maybe even higher, off those lows in the S&P 500, okay? That is a historic move. If we had a sideways consolidation day from now until, say, July 4th, that'd be perfectly healthy. If we had a 10% correction, I know you're going to have some concerned clients, but after a 70% rally, a 10% correction would honestly be healthy and normal to catch your breath. So I think it's so important for people to understand we've been spoiled by what we've had the last 10, 11 months. A little rockiness could be perfectly normal, but use it as an opportunity. And I'll end it with this. They say this about the stock market. It's the only place where things go on sale, yet everybody runs out of the store screaming. Okay, just remember that when we have these pullbacks, use as an opportunity to reach your long-term investment goals.
And for those that can't do that, we talk about corrections and bear markets as natural, normal, and necessary. They've got to be part of it, because then it becomes gambling if it isn't. I mean, it's just like it's going to go through there. You want to weed out some of the traders, keep the investors in there, and that in the long run is healthy. So I tell you what, I have really appreciated this, Ryan. I really appreciated this. I know I was reading up a little bit about you. I noticed you said that the highlight of your career was you got some kind of X on, was it CNBC or something along? I'm not sure what that means. But I want to give you.
Yeah, so I went to Xavier University in Cincinnati. We always put an X up. I can't tell you why.
Sure,
yeah,
now it makes sense.
What happened? Yeah, Joe Kernan knows that. Joe Kernan's a Cincinnati guy. I'm a Cincinnati guy. When I was on TV with Joe last week, I said something about, hey, St. X, which is a high school where Joe went in Cincinnati, they won the state championship in Ohio like 44-3 or something. What biggest butt kicking you've ever seen in a state championship game. So I started CNBC off talking to Joe about that. Because let's be honest, Joe can be a little cranky some days. But I know if I start off with that, he'll be in a good mood. So he actually gave me an X on live TV at the end of the interview. So I've done TV for a while. I kind of know how to do it. Butter him up a little,
That's great. That is great. Well, listen, I've appreciated it very much. I know my investors will appreciate it. I appreciate what you do for the firm. This firm has been very good to me. You know, I was like number 400. I was like the 400th broker here. In fact, I was actually with LPL before it was LPL. It was just Private Ledger, and then Todd Robinson bought it. So I've seen a lot of sunsets, and it's provided for our organization to allow a platform with astute individuals like you helping us with our investors who come to us with their hopes and dreams and their trust. So Ryan, thank you very much. I hope you and yours are safe and healthy. We'll look forward to a post-COVID time when we can get back together. But once again, thank you so much, sir, because I do know that your time is valuable. A lot of people are asking for it, and I've appreciated that you took the time for me and my clients.
No, I'll just end with this. I'm honored. Thank you so much. We'll definitely do this again soon. And everything you're doing for your clients, it goes a long way. I get to I meet a lot of advisors and brokers, and the fact you're doing this, reaching out, your clients are in very, very good shape, and they're in good hands. So guys, if anything I can do, reach out to me, but just keep listening to Dave. He knows what he's doing. So that's awesome. Thank you.
Very good. Very good. Thank you so much, Ryan.
Thank you.